Okay, so now we are at chapter number 10. Okay, so we have 4 more weeks to go before the end of the semester. So as usual, one topic per week. So we have 4 more weeks to go with 4 more chapters to go. So next week, we will start on chapter number 11. Okay, so today, hopefully we can finish our chapter number 10 and perhaps do a few revision questions on that. Okay, and you always have the last semester video recording in your OL. Okay, if you need more, I think last semester I did more revision on that on this chapter, and see whether we can do the same this week or maybe next week. Okay, last Monday I introduced to you on chapter number 10. Okay, on the national income equilibrium. So we discussed. Okay, I introduced you on the two sector economy, C plus I, and also, so today we're gonna cover, finish on the 3 sector with the government role in the market. Okay, so what happened last Monday, okay, when we discussed on the consumption function. C equals to A plus BY. A is the autonomous consumption, and B is the MPC, marginal propensity to consume. For every $1 increase in the income, how much is the increase in consumption? Okay, and the value of the B, MPC, should be between 0 to 1. And 1 minus B actually is the MPS, okay, marginal propensity to save. Okay, and we also look at this equilibrium function, okay, using the 45-degree line, or what is also called as the income, the Y line, okay, or the aggregate demand line. Okay, so you have this 45-degree line whenever it intersects with the consumption function. So this is the equilibrium output. Okay, so whenever the value of this line intersect, so you can find the equilibrium output. Okay, and then we also look at the saving function, which is okay. So you can see from the same graph, okay, the consumption function and also the saving function. So saving always start, the intercept will always start at negative, okay, because whatever money that you start spending from the autonomous consumption A. So if A is, let's say, 100, so B, I mean, for saving function, this will be negative 100. So it will be the same value but negative sign. Okay, and then because the slope of the saving function is the complement of consumption function, because MPC, MPS is 1 minus MPC. So if this slope is 0.75, so this slope will be 0.25. Okay, because the addition MPC plus MPS will always be equal to 1. So we discussed that one as well here. So here is the MPC plus MPS. Okay, and we also look at when we include investment. So and then we introduce the concept of aggregate expenditure, AE. AE for a 2-sector economy is when C plus I. So remember, investment is a constant value. Planned investment is a constant value. So when you add investment together with consumption, 100 plus 0.75y plus 25, so you will move the graph parallel upward. Okay, so you can see here 100 move to 125. So C plus I is the aggregate expenditure line, AE, okay, with only including investment. Okay, and then when the AE line intersect again with the 45-degree line or the output line, okay, you will find this equilibrium value. Okay, Y equals to C plus I. So today we will discuss with the inclusion of government expenditure, C plus I plus G. So if you recall from chapter number 9, when we learn about calculating the GDP using expenditure approach, C plus I plus G plus X minus M. So basically this is what the when we include government into the equation. Okay, and another way to calculate equilibrium, okay, if you look at this diagram just now here, okay, I think last Monday we stopped until this slide here, okay, until so we will discuss, continue a bit on here, and then I will use the Arnold slides, okay, the other slide from your OL, Okay, to continue with the remaining of chapter number 10. Okay, so from when we use the concept AE, aggregate expenditure, okay, C plus I, and we find the output, the equilibrium, when the AE line intersect with the 45-degree line. So this point is the point where AE intersect with aggregate expenditure line intersect with the 45-degree line. Okay, the 45-degree line is also called as the Y line, okay, the output line. So at this point, you can see that the equilibrium point is 500. The value is 500. So another way to find the value of 500 is by using the saving equals to investment function. Okay? S equals to I approach. So whenever saving value equals to investment, when the two lines intersect, okay, so that will also you can also find the value of the equilibrium using the saving equals to investment approach. So you can see here, when the saving lines intersect with the investment line, it will intersect at the same value of 500, which is the same value that we find here when aggregate expenditure line intersect with the output line, with the 45-degree line. So you can see at this point, 500. Okay, so it will be the same as when saving is equals to investment. Okay, so if you look at this slide here, so how do you calculate the value of equilibrium output using the equilibrium approach? Okay, we know that Y is equal to C plus I, correct? Okay, Y, okay, which one is Y? Y is the 45-degree line. So when Y equals to aggregate expenditure, okay, you are referring to when the two lines intersect. So this function here, Y equals to C plus I, is basically when the 45-degree line is intersect with the aggregate expenditure line. So Y is equal to EE. Remember, EE is C plus I. So when, and we know that consumption function is given as A plus BY. A, which is the autonomous consumption. B is the MPC, marginal propensity to consume, or the slope of the consumption line, and multiply by Y. Okay, remember, Y is also known as YD, disposable income. Okay, of course, we only use the notation Y, but sometimes you can also use, you can see some book use the notation YD, okay, disposable income, income after tax. Okay, and here we are also given the I, the amount of investment. So when we include, when we solve for the function C plus I, okay, 100 plus 0.75 Y plus I, you will get this one, okay, which is you sum together, you will get 125 plus 0.75 Y equals to Y. So just a simple simultaneous equation. You solve for Y, you should get Y equal to 500. So basically this 500 is what the value that you see here. Okay. So when the Y line, the output line, Y equals intersect with the AE line, C plus I, you can find the value of your GDP, okay, or the equilibrium value. Okay, so remember, this is one of many examples, okay, the type of questions that you can be assessed, okay, or that you can be tested on, okay, when it comes to chapter number 10, determining the value of Y using this simple equation. Okay, so as long as you know that how to derive the aggregate expenditure function, C plus I, you add them both and you solve using the simple linear equation, okay, simultaneous equation. So you should get Y equals to 500. Okay, so in the next few slides, okay, I'll be switching to the unknown slides because we have more detailed discussion on the on what we call as the multiplier concept. So what is multiplier? Multiplier means, for example, if you put $1 in a, let's say you give somebody $1, okay, so maybe $1 is a bit too small. Let's say you give one person 100 ringgit. With this 100 ringgit, let's say that person buys some equipment, okay, let's say to sell something, okay, maybe the person use this money to buy, okay, certain inputs, okay, for certain machine, certain input from shops, and he used this money to do a small business. Okay, so from 100 ringgit, it might multiply, let's say it might become 400 ringgit. Okay, so let's say you give someone 100 to start doing a small stall, okay, selling, let's say, some food, okay. So from this 100, the person might buy some input, bahan mentah, okay, some, equipment to start doing a small scale business, okay, maybe selling drinks. So from that 100 capital, it might grow to, let's say, 200 ringgit, 300 ringgit worth of money. So that is what multiplier means. You put certain amount of money and that money will multiply in value. So the same thing with the economy. When you put certain, when you increase the amount of the money into the economy, okay, let's say you increase investment by $100, okay, sorry, by 100 million. Okay, 100 million increase in investment, the impact to the GDP will be more than 100. It might cause the GDP to increase, let's say, up to 200 million. So a 100 million increase in GDP in investment may cause GDP to increase up to 200 or 300 million. So that is what we call multiplier. Okay, the amount that money that we put into the economy will expand by more than one times. Okay, so here we want to study what is multiplier. Okay, what are the types of multiplier? We have investment multiplier, we have government expenditure multiplier, and we also have tax multiplier. Three types of multiplier that you need to know how to calculate, okay, how to solve for the problems when it comes to determining the correct formula to calculate multiplier, because this is one of the most popular questions when it comes to chapter number 10, is to solve for the multiplier problems. Okay, so so let us switch to the annual slides, okay, from your OL. Okay, so I'm not going through this so I will just briefly explain this slide. So last week and the beginning of our lecture today, I explained on the two sector economy, correct? C plus I. C plus I is what we call as the aggregate expenditure. Okay, this one. Okay, AE is C plus I. So we only include C plus, if we only include C plus I, we are calling this a two sector economy. Okay, two sector economy. But when we include G into the equation, then it becomes a three sector economy. Okay, because we know that any country in the world, okay, there will always be a government in the country to facilitate the running of the country. Okay, using government money to increase the value of the economic activity. And also whenever you have government, you also have tax, okay, tax and subsidy, for example, from the government. Okay, so we discussed on the C plus I component last Monday. Okay, so today we're gonna finish off with the government role, and from here we can expand on the concept of multiplier, because as I mentioned just now, okay, the concept of multiplier, there are three types of multiplier: investment multiplier, okay, investment multiplier, government expenditure multiplier, and also tax multiplier. Okay, so in the annual slide, we will discuss these three types of multipliers and how to calculate them. Okay, so in the two sector economy also, we can find the amount of the level of equilibrium using S equals to I. Whenever saving is equal to investment, that value will also represent the equilibrium value. But in a three sector economy, you can find the value of equilibrium. Okay, one method is using the Y equals to C plus I plus G. Another method is using this formula as well. Saving plus tax, the S stands for saving, the amount of saving plus the amount of tax, whenever it equals to the value of investment plus government expenditure, that will also give the amount, the value of the equilibrium GDP output. Okay, so you can see the difference between two sector, S plus I. So S plus I is still here, but then it is matched by P and G, okay, tax and government expenditure. Okay, remember, because government gets their money from tax. So the tax money that the government collect, they will spend the money onto the public. Okay, build roads, buildings, okay, and other things. Okay, pay salaries to the workers. So G, the partner will be tax. Okay, I, the partner, is saving, because money from saving is used for investment. Okay, so that is the idea of equilibrium, two sector versus three sector economy. Okay, so here we also I will introduce briefly on the concept of leakages versus injection. So what is leakage? What is injection? Injection means money going into the economy. Okay, leakage is money going out from the economy. So from the equilibrium approach here, you can see what are the components of injection, what are the components of leakages. Okay, so injections means money going in, so the component will be I and G. Okay, whereas leakages, money going out from the economy, so it will be the form of T and S. Savings means money is taken out, because when you put money into the bank, the money is not spent. Okay, so that is also a form of leakage. And also tax payment, because when we pay tax to the government, it's a form of leakages from the household perspective. Okay, because we do not have, meaning that we have less money to spend when you pay tax. Okay, the same goes to savings. When you put money in bank, meaning that you have less money to spend because you put the money into the bank, meaning you're not going to spend that money. So tax and savings are a form of leakages. Okay, so basically the leakages, when leakages equals to injection, that is what this equation is about. I plus G. The I plus G is the injection. When injection is equal to leakages, okay, you will achieve equilibrium, which is what this slides mean. So I plus G is basically injection. S plus T is basically leakages. So this is also another popular concept. Okay, what are the components of injection? So sometimes you may be getting a combination of investment plus saving, investment plus tax, or investment plus government expenditure. So you need to know this what fall under the category of injection, what fall under the category of leakages. Okay, money going out and money going in. Okay, and then we discussed this one. Okay, the expenditure approach in the previous chapter. So we're not going to discuss. So we already discussed this part A plus BYD. Okay, autonomous consumption plus marginal the slope of the consumption function plus the multiply with the income, with the disposable income. So we discussed this one previously, with including also the saving function. Okay, but this part here, I think we did not see it from this perspective. Okay, so if you recall from our discussion last Monday, okay, we know that savings, okay, whatever money that you don't spend, we assume that the money will be saved. Saving is basically equals to Y minus C. So whatever money that you don't spend, you end up saving. So how do you construct? But we know that, okay, consumption function is C equals to A plus BY. A is the autonomous consumption, B is the MPC. And we also know that MPC plus MPS always equals to 1, correct? This one, MPC plus MPS. Okay, so how do you calculate MPS? Okay, by right, once you know MPC, you should know MPS already, because MPS is basically 1 minus MPC. So how do you construct saving function? Okay, we know that consumption function is C equals to A plus BY, correct? So that is consumption function. How about saving function? So basically saving function can be written as negative A plus 1 minus BY. Okay, so if you look at this function here, basically it's just the opposite of saving consumption function. Okay, if you recall, consumption function is A plus BY. A means autonomous consumption. And we also have looked at this concept just now, okay, from last Monday. Okay, if A is 100, then saving will be negative 100, means saving will be negative A. So that is what you see here. Okay, negative A, because basically we are just using the negative sign from the consumption, autonomous consumption. Okay, if consumption is autonomous consumption is 100, then this will be negative 100, as what you see here. Okay, 100, here will be negative 100. Okay, because it's just because when income is 0, whatever amount of money that you spend, that is taken from saving. So that's why maybe the money that you borrow from banks. Okay, so here you can see that saving function can be written as negative A, okay, plus 1 minus B. Okay, why 1 minus B? Because this part 1 minus B is what we call MPS, marginal propensity to saving. So this is equals to 1 minus B. Okay, so if you know what is MPS, sorry, if you know what is MPC, marginal propensity to consume, from the consumption function, so you can just minus that by 1. Okay, so B is MPC. So 1 minus MPC is will equal to MPS. So if you know what is, basically, once you know the consumption function, okay, if you know what is consumption function, then you can derive what is saving function automatically. Okay, correct. For example, if we look at this slide again from the other, okay. So what will be the consumption, the saving function then? If C is equals to 100 plus 0.75y, so so saving function will be S equals to negative 100 plus what? Okay, 0.25, okay, plus 0.251. Okay, so this will be the saving function, negative A plus 1 minus by. Okay, so saving function will be negative 100. If this is A, 100, so saving function will be negative A plus 1 minus B. So B is 0.75, 1 minus B will be 0.25y. So that is how you derive saving function. Okay. So, and the intercept will always start from negative lah, of course, because it is negative A then by definition. Okay, so that is how you construct saving function. So last Monday, we did not discuss how you construct saving function. We only discussed saving is basically y minus c. Okay, but once you know the saving function, you can derive automatically what is the saving function. Okay, so continue from here. Okay, okay, so if okay, so this is okay, so you can calculate. So if you know MPC is 0.8, okay, you can also calculate what is the amount of okay, let's forget about this slide first. Okay, because the focus for today will be on the multiplier concept. Okay, so we discussed also this one last Monday. MPC plus MPS will always be equals to 1. Okay, so 1 minus MPC, or you can see this as 1 minus B. Okay, so MPS will be 1 minus B. Okay, so MPS will be 1 minus B, because MPC, the notation will be is equals to B. So 1 minus B is equals to MPS. Okay, so this is what you need to fully understand at this stage. Okay, besides APC, we also have the concept of APC and APS. A stands for average. Okay, the same goes. Okay, APC plus APS is also equals to 1. Okay, MPC plus MPS also equals to 1. Average propensity to consume plus average propensity to save will also be equals to 1. Okay, but the focus will be more on the MPC and MPS, because that is the focus of how you calculate multiplier. Okay, so here you can just refer to the slide to see how you fill in the blanks lah. Okay, but I'm not going to focus on that today. Okay, so let's go straight to the okay, please go through the slides, okay, just to see how you calculate the output level, which is similar to what we discussed just now. Okay, C plus I, so you know, you just add saving consumption function plus investment, and you can solve what is the value of the equilibrium output. Okay. Okay. Okay, the same thing here. Okay, if you look at this example here, so now we are at the 3-sector economy, correct? So today the focus will be on to include the government role, the government expenditure. So last Monday, when I introduced to you on this, from last week, from last Monday lecture, okay, we only focus on the aggregate expenditure on using C plus I, meaning only on the 2-sector economy. Okay, but if you include government into the equation, now aggregate expenditure is equal to C plus I plus G. Okay, so this is on the three sector economy that we mentioned earlier. Okay, so this is what you learned before, right? C is equal to A plus BY. Remember, sometimes we use only the notation BY. Sometimes you can also use the notation YD. Why? Because YD is disposable income. Okay, so whenever you see the notation YD, actually how do you calculate YD? YD is Y minus tax. So if you know the amount of tax, then you can calculate YD. If you're not given the value of tax, then you just use the notation Y. Because remember, okay, you have two sector economy, you also have three sector economy. Okay, in the beginning of the slide, we look at this summary here. Okay, in a two sector economy, there is no tax component. So Y is basically just Y lah. But when you include tax into the equation, then now Y must be YD. Okay, because you have to minus the amount of tax, okay, paid by the household. So here what you see, okay, in a three sector economy, okay, so C equals to A plus BY. Okay, but when you include the tax into the equation, now this become YD. So YD is basically Y minus tax. So if you are given a question where you have the amount of tax, then you need to plug in the value of tax into the value of Y here, because Y is no longer Y but becomes YD. So you need to know whether you are dealing with two sector economy or three sector economy. Basically, if the question mentions about a three sector economy, or in the information there is the amount of tax, so you need to construct your consumption function this way. Okay, meaning C is equal to A, autonomous consumption, plus MPC multiplied by Y minus T. So so here you can see how that is calculated. Okay, so given this simple information, calculate the amount of GDP, okay, the amount of equilibrium output. So we know that in a three sector economy, it will be C plus I plus G, correct? C plus I plus G, correct? So Y is equal to C plus I plus G, okay? And your C function, okay, whenever you have tax, now the C function will be C plus C plus A plus BYD, okay, this one, okay? Yeah, this one, okay? C is equal to A plus B multiplied by YD, okay? So previously we just mentioned C is equal to A plus BY, correct? From our discussion on last Monday, okay? Whenever you write consumption function for a two sector economy, you only use the function C equals to A plus BY. So this function is only when there is no tax in the system, or you are only dealing with a two sector economy. Okay? But whenever you are dealing with a three sector economy, why you need to write as YD? Okay? So using this function, if you're given a simple question like this, calculate the amount of GDP, okay, or the equilibrium output. So C will be 100 plus 0.8 YD. Okay, so I equals to 200, G 150, X 100. So how do you calculate them? So basically just use the simple equation C plus I plus G, okay, 100 plus 0.8 YD plus investment 200 plus G 150. Okay, so but you know that YD is Y minus X. Okay, so X is given as 100. So plug in into the equation and you can solve Y is equal to 1850. So that is how you solve for equilibrium output when you are dealing with a three sector economy, whereby there is the amount of tax and also government expenditure G. Okay, so I hope you are clear on the simple example C plus I plus G, but your C here is Y minus T because you are using the notation YD, that stands for disposable income after tax. That's why you need to minus with the tax value. So Y minus T is basically disposable income. So you remember, so here from this simple example, Y is 1850. So we will go back to this example in the next few slides. Okay, we are going to use this number again, okay, or this value again. Okay, so equilibrium is achieved. Okay, if you recall from our last Monday lecture, Okay, in a two-sector economy, okay, when the aggregate expenditure line AE, okay, when AE line intersect with the Y line, okay, so the 45-degree line or the Y line intersect with the aggregate expenditure line, that is when you achieve equilibrium C plus I. Okay, two-sector economy. But in a three-sector economy, you have C plus I plus G. Okay, in Arnold textbook, they use the word, the notation TE. Okay? TE can also be used, or it can also be used as AE, aggregate expenditure. Okay, so you can see here, this 45-degree line in the Arnold textbook, they use the symbol TP. Okay? Sometimes you can see some book use the word Y, I mean the notation Y. Okay, both are correct. Okay, whether TE or AE, both are still correct. Okay, so as long as you understand the difference between two sector and three sector, because whenever you see component G here, that refers to a three sector economy. But when you only use C plus I, okay, as what we discussed last Monday, C plus I. So this is when this is on a two sector economy. So please get your understanding correct, okay, when it comes to two sector versus three sector. But the concept still remain the same. When the output line, the Y line, intersect with the aggregate expenditure line, okay, then you will find the amount of equilibrium. Okay, the two lines intersect, so that is when the economy will achieve equilibrium. Okay, so other than that point, okay, that there is this equilibrium. Okay, so now that will bring us to the concept of multiplier again. Okay, so having mentioned, okay, how we construct our saving function just now, okay, if you recall, saving function if negative A, okay, this one, saving function is derived as negative A plus 1 minus B YD, okay, compared to save consumption function equal to A plus B YD, okay, autonomous consumption plus MPS, MPC, marginal propensity to consume, multiplied by B, okay, multiplied by YD, disposable income. So the opposite will be for saving function, negative A, okay, negative A plus 1 minus B, okay, multiplied by disposable income. So why do I need to refer to this again? Because that will make your understanding on the concept of multiplier much better. Okay, so first, I mentioned earlier, there are three types of multiplier. Government multiplier, government expenditure multiplier, investment multiplier, and also tax multiplier. There are three types of multiplier. Okay, G multiplier, investment multiplier, and also tax multiplier. So you need to know each of the different type of multiplier and how to calculate them. Okay, so first we look at investment multiplier. So what I can inform earlier, okay, just for a quick note, investment multiplier, the formula will be the same as government multiplier. Okay, I multiplier will be the same approach. So whenever, if you want to calculate investment multiplier, the same process is used to calculate government multiplier. The only difference is that you replace the symbol I with the symbol G. Okay, so that is the only difference. Okay, but this part here, this component is the same. Okay, whenever, so please bear in mind, investment multiplier will be similar, okay, not equal. It's similar to the process to calculate government multiplier. Okay, so if you look at this formula here, uh, okay, so which part from this equation is the multiplier? This is so the multiplier actually is this one. This is what we call multiplier. Okay, so this part is what we call the multiplier. Multiplier. Okay, sorry for the disturbance. Okay, so whenever you see the word multiplier, so you need to know which component in the formula represents the multiplier value. So for investment multiplier and also government multiplier, government expenditure multiplier, this part here, 1 divided by 1 minus b, this is the multiplier value. Okay, so if you look at this simple equation, okay, so basically the idea of multiplier, we want to know, okay, I give a simple idea just now, or simple example. You give someone $100 or 100 ringgit, and that person will start doing a small business. Okay, let's say selling drinks, for example. So from that 100 ringgit that you give to the person as the capital, as the modal, the person will start doing business, and maybe from that 100 will grow to, let's say, 200, 300 ringgit. So basically, you want to know what is the changes in the amount of output, okay, in terms of economy, okay, as a country. We want to know how much is the changes in the GDP value when we put certain amount of money into the economy. So if let's say an investor, okay, from Japan, for example, come to Malaysia, so that person gives 100 million ringgit to the government for an as an investment, okay, to build factory, for example. So our investment has increased by 100 ringgit, sorry, 100 million ringgit. Okay, so investment changes by 100 million. We want to know from this 100 million change in investment, because when new investment comes in, we treat that as the changes in the investment lah. So what investment increased by 100 million, we want to know what is the effect on the GDP. We want to see how much does our GDP changes. So that's why the sign that you see here is always in terms of change. Okay, because we want to see, given a change in investment, what will be the change in the output for the GDP. Okay, and the changes in investment is also subject to the multiplier value. Okay, for example, the Japanese company from Japan put 100 million into the economy, so GDP will increase more than 100 million. That is what the idea of multiplier. Okay, so 100 million will be I, okay, will be this component. Change in investment will be 100 million. So 100 million times a certain value. So the product of this multiplied by 100 million will give the amount to be more than one. I mean, our GDP will change by more than 100 million. That is the idea of multiplier. You put certain amount of money into the economy, and that money will grow in terms of the value. Okay, so I mentioned just now, this is investment multiplier. So the formula is change in Y equals to, change in Y means the GDP, changes in the GDP value equals to the multiplier value multiplied by the change in the investment value. Okay, so what is 1 over 1 minus B? Remember, B here is the MPC, marginal propensity to consume. If you recall, our C function is A plus BY. Okay, correct? B means MPC, marginal propensity to consume. So 1 divided by 1 minus B is 1. Basically, 1 minus B is our MPS. Okay? Because MPC plus MPS equals to 1. So 1 minus B is basically MPS lah. Okay? Because that's why I always go back to the saving function just now. Okay? Because saving function is derived as negative A, okay, negative A plus 1 minus B YD. Okay? Whenever you see a saving function, okay, like this, C is equals to negative A plus 1 minus B YD. So 1 minus B is what we call as MPS, marginal propensity to save. Okay? So if you know the consumption function, you can derive the saving function as I showed just now. So from the from the consumption function, you know what is B. B is the MPC. Okay, MPC. So 1 minus B, you will get MPS. Okay, or once you know MPC, you can know MPS by deducting the value of MPC by 1 lah. So 1 minus B is equal to MPS. So the same thing goes here when it comes to the formula of multiplier. Okay, so 1 divided by 1 minus B. So 1 minus B is basically MPS, marginal propensity saving, okay, or marginal propensity to save. The important thing is once you know A, once you know the value of B, so 1 divided by 1 minus B will be the value of the multiplier. Okay, so let's see a simple example here. Okay, okay. So you can see in this slide, okay, you have the function, the component for the three sector economy, consumption function, the G value, government expenditure value, the investment value, and also the tax value. Why we need the tax value? Because in this YD is Y minus T, correct? So we need to know what is the amount of the original GDP value, because we need to know if there is an investment coming into the country, okay, how much does our GDP changes, okay? So to know how much is the change, you need to know the old value, the original value. Then you can see how much is the changes. Okay, so here you can see that, okay, the formula, this is the information given. Suppose an investment expenditure increase to 300. Okay, increase to, okay, the word is to, not by. Okay, increase to 300. Okay, so original investment is 200, increase to 300 means the increase is by 100. The value is, the change will be 100. Okay, from 200 increase to 300. So the change value, remember the formula is given as, okay, the formula is given as change in Y. Okay, so change in Y means you need to know the original value and also the new value. So new minus old, you get the change value. So this example here is what the information is about. Okay, so original is 200, new is, oh, sorry. Okay, original is 200, the new is 300. So 3 minus 2, you get the change to be 100. 100 lah, $100 lah. Okay, so now the formula is 1 divided by 1 minus B. B is 0.8. Okay, we know that the consumption function is C equals to A plus BY. Okay, so 0.8 is our B. So 1 divided by 1 minus B multiplied by the change value, which is 100, you obtain by 300 minus 200. New investment value minus the old investment value, you get the changes value. So when you solve for this, you get the multiplier value is basically equals to 5. 1 divided by 1 minus 0.8 or 1 divided by 0.2, you get 5. So in this simple example, the multiplier value is 5. So 5 is the multiplier value. When you put 100, when investment increase by 100 ringgit, okay, GDP will change up to 500 ringgit. Okay, so the change in investment, sorry, the change in output will be by 500 ringgit. Okay, 500 ringgit is not the new GDP, it's just the change in the GDP. Remember the formula. The formula is in terms of changes, not in terms of the exact value. So when GDP changed by 500, okay, so you want to know what is the new level of GDP, because 500 is not the GDP value, it's just the value of the change in GDP. So you need to know what is the old GDP, and then you can plus with the changes in the GDP, and then you can see what is the new GDP value. So from this example, okay, how do we know that Y0 is 1850? Okay, so if you recall from our earlier example, okay, I mentioned that, okay, how do you calculate GDP? How do you calculate Y? C plus I plus G, you will get GDP. Okay, and then here Y, you need to solve for Y. Y is Y minus T, correct? So if you go back to the earlier example, this one, okay, even this simple example, you can calculate the GDP to be 1850, correct? C plus I plus G, C plus I plus G. In this Y, you need to solve for Y minus T, and you get the original GDP to be 1850. So this is the original GDP. So in this example just now, that you see here, Y subscript 0 is the original GDP plus the change in the GDP that you see here. So the new GDP after investment increased by 100 ringgit is 2350. So that this is a very important example, okay, or way how to calculate, how to use multiplier to solve for determining what is the new value of GDP. Okay, so you need to know, first you need to know what is the whole GDP, 1850, and you also need to know what is the new changes in GDP, 500. You add them both, you can get what is the new level of GDP. Okay, so the information that you need is 1 over 1 minus B. B is the MPC that you can get from the slope of the MPC. Okay, so and then 100 is just the change from the new investment minus the whole investment. Okay, how about government multiplier? I mentioned just now, government multiplier is similar to investment multiplier when it comes to the formula. The only thing that you change is the symbol from I, you change to G. But this part is the same. This is the same. This is the same. The only part is you change from change in I to change in G. Okay, remember, why is they are the same? Because investment and G both are injection. If you recall from our earlier slide, okay, today when I use the annual, okay, injection is I and G. So both I and G are injection. That's why we treat both similarly in terms of the effect to the economy, because both are money coming into the economy. The same goes with saving and tax. Both are linkages. So the impact of multiplier of tax would be the same as the impact of multiplier for saving, because both are money going out. So let's go back to the example here. Okay, so just now we look at this investment multiplier, 1 over 1 minus B. So this is the multiplier value multiplied by change in I. So if you want to look at government multiplier, the same approach, only change to change in G. So 1 over 1 minus B, okay, or in other words, it will be change in Y equals to 1 divided by MPS. You can also write this way so that you can understand the concept of 1 divided by 1 minus B. 1 minus B is basically MPS. So 1 divided by MPS multiplied by the change in G. Okay, so this is MPS. Okay, or you can also put 1 divided by 1 minus MPC. It's the same thing also. Okay, why you need to see from different angles so that you can understand what is B. B is MPC. 1 minus MPC is equal to MPS. Okay, because sometimes you might be given directly the value of MPS. So just plug in and then multiply by the change in the G or the change in I. Okay, so using this similar approach, you can see how you can solve for government multiplier. Assume that government expenditure increased by. You can see here, this one is increased by, not increased to. By means this is already the changes value. So you need to understand the term used in English. Okay, I cannot teach you English. So either you know or you don't know, or you don't understand. Okay, so increase by mean this is already the changes value. Okay, so and then just plug in using the same approach. 0.8 is the MPC. 1 divided by 1 minus 0.8 multiplied by the change in G, which is change by 1 to 5. And you get the change in income changes by 6 to 5. So using the same approach, Y1 is Y0, all GDP, plus the new change in GDP, you get the new amount of GDP. Okay, 1850 plus 6 to 5. Okay, so you just use the similar value 1850, okay, plus with 6 to 5, you will get 2475. That is government multiplier. So you can see that government multiplier and investment multiplier both are calculated similarly. 1 divided by MPS multiplied by the change in investment or the change in government expenditure. So make sure that you put the value correctly, okay, because the value must be in terms of changes, okay, not the actual new. If you look at the investment example just now, if you put here 300, then it's wrong, because 300 is not the changes, it's just the new value. So you need to deduct first with the old value to get the change value. So that is one of the common mistakes done by students during test. Okay. Thirdly is the tax multiplier. Okay, so we have government and investment, both are calculated the same way. Okay, but thirdly is the tax multiplier. Okay, so the multiplier value is different than the multiplier that you see. Okay, if you recall, the government and also investment multiplier, the formula is for the multiplier is 1 divided by 1 minus B. This is the multiplier value. 1 divided by 1 minus B. However, for tax multiplier, the formula is negative B divided by 1 minus B. That is, don't forget this negative sign here. So, negative B divided by 1 minus B. Okay, so this part is the same. The denominator is still 1 minus B. But the numerator, okay, under the government or investment multiplier is 1. But here is negative B. Okay, so negative B divided by 1 minus B multiplied by the changes in tax. You can see, so tax multiplier, so this is tax value lah. Kalau government, this is G. Kalau investment, change in I. But the multiplier value is different. Okay, so the same thing here. Okay, if government increase tax collection by $80, okay, by 80 ringgit. So we know that this part will be the change value. Change in tax will be 80, 0.8. Okay, so but then what is the new value of GDP? So we know that the first you need to solve for the multiplier value. So it will be negative B. We know that B just now from the consumption function is 0.8, correct? So using that information, negative B, negative 0.8 divided by 1 minus 0.8, okay, you get the multiplier value to be negative 4. So negative 4 is the multiplier, the tax multiplier value. Okay, multiply by 80, which is the government tax change by 80. So by the word by is already measuring changes. So we can see that when there is a tax of $80, GDP will change by or will reduce by 320. So when you want to find out what is the new GDP value, whole GDP minus changes in GDP, you get now our GDP value has reduced up to 1530 from 1850, now has declined to 1530. Okay, so this is a very important concept, okay, that you need to know, not just finding what is the new GDP, but also from this example, from these three examples that we have seen just now, what is the value of multiplier? Okay, so for investment and GDP, government expenditure multiplier, the value is 1 divided by 1 minus B, which is, in this example, the multiplier value is 5. Okay, 5 is the government multiplier value and also investment multiplier value. Okay, but for the tax multiplier, the value is negative 4. So negative 4 is the tax multiplier value. Okay, so negative 4 multiplied by the change in tax, which is the change here is equals to 80 ringgit. Okay, so when you plug into the problem, what you get is not the new GDP, it's just the changes. So remember, whatever value that you solve from this equation is just the change in the value. So you need to know the original plus the changes value that you solve to get the new output level. Okay, so this is something that you need to pay attention whenever you want to solve for multiplier value. Okay, so I think that's it for our discussion when it comes to the lecture notes. Okay, it's 2:06. So what we will do is not sure whether next Monday, okay, before we start with our new lecture, okay, on chapter 11. So what I will do is I will briefly discuss on some of the questions from chapter number 10, okay, from past years, okay, and then we will see how what is the solution for it, and then we will start on the new chapter number 11. Okay, so because I think there's a lot to digest today, so okay, so I think what